I got a friend who just talked to me on the phone, and I think a lot of you will connect with what he told me. And basically, this was the conversation. He told me, "Look, Tom, I'm not a rich guy. I have a little portfolio, about $150,000. This is basically for my kids, for whatever medical stuff, whatever, God forbid. This is money I don't want to lose. And this money is not something I gamble with. I like to have a little bit of risk, but I'm not going to YOLO it into Doge or whatever on options. I only invest in stocks, only long, and I only go for good companies." But somehow, despite everything I just told you, that was him saying to me, the market has absolutely played one on me, and I just lost $50,000 out of the 150 that I had for the past 9 or 10 months. Ever since December, I'm down 50 grand. Why? I don't deserve this. I'm a cautious investor. I invested in good companies. I didn't take any crazy exuberant risks. I didn't YOLO into crypto. Like, why do I deserve this? I can't do this anymore. The market is rigged. I can't win. I'm taking my L. Whatever. I'll take my 100K and I'm just out for good. This is not for me. And this is the conversation I had with him, and I think it will be valuable for you guys to hear as well, because I'm sure some of you, whether you want to admit it or not, are dealing with a very similar situation, at least mentally or emotionally. Now, obviously, I can't tell him what to do, and I cannot tell you what to do, and this is not financial advice. I'm just a guy on the internet with an opinion, and I'm sharing it with you. So whether you want to get out of the market, stay in the market, whatever investment decisions, you got to talk to a professional and talk to your advisor and whatnot. This is not the point. The point here is to plant a seed in your head and get you to start thinking a little bit different, okay? Okay, let's cover our bases here. So what's going on right now in the market and why he feels like he's a victim? Okay. So first of all, look, there's a very famous saying that the markets, they drop like an elevator and they go up like somebody who's walking up the stairs. Because look, for example, a guy who's lost, like, let's say 33% over the past 10 months is going to have to do about 50% in revenues and profits out of the stock market to get back to it. So the idea here is that a stock that drops, let's say 33%, is going to have to go up by 50% just for you to break even. Now, how likely is a stock to go up by 50%? Not very likely. It doesn't happen very often. And, I get it. It's a tough choice. And I totally understand why he feels this way. Now, first of all, I'm going to say it right here. The one thing I didn't tell him, and I'm not going to tell you, is this mumbo jumbo about how things can never get worse. I hear a lot of these yahoos, idiots who have no idea what they're talking about. How, well, things can't get any worse. We're in the recession already, Tom, which I, by the way, agree with. The market is already down, like the NASDAQ is down like 30+%. I mean, how low can it go? Well, motherfucker, it can go a lot lower. So just saying, hey, it can't go any lower, this must be the bottom, and just, it's a very irresponsible thing to say, especially to novice investors, especially to retail investors. Things can be worse. They can be significantly worse. So just assuming you want to stay in the market because it cannot get any worse, it's a very dangerous thing to say to people. And I advise you, and this is advice, not to say stupid shit like this to new investors and somebody who's not experienced. For example, go back and look in history. In 2000, 2008, the market dropped like 50%. I'm talking about the index, not individual companies. That's a whole different enchilada. So let's not assume that this is the bottom because it cannot get any worse. It can and it might, who knows. But that has nothing to do with your investment strategy and whether you stay in the market or do not stay in the market. Those are completely different things, okay? Okay, let's talk about it. What just happened here? Look, here's what happened. The stock market basically had this extravaganza. Everybody had free money. You get free money. You can borrow money basically for free. You invest in the stock market. Boom, there's an explosion. It's pretty much like playing a video game on easy mode. Everything you shoot is a kill. Everything you score is a basket or a goal, whatever, right? All of a sudden, interest rates start going up. The money starts to dry up. There's not so much liquidity in the market. Money is more expensive. So if you want to play around in the stock market, and the same goes for real estate, by the way, you need to borrow money. That money is expensive. So now the game went from easy mode to super duper expert mode in just like a year. And that's going to get a lot of people flying out of the game because they can't win. When you play a video game and you're absolutely getting annihilated by the computer, you're going to want to shut it off. It's not fun. So that's going to scare a lot of investors off the market. And, that's why you're seeing a lot of this abandoning going on with the stock market. I'm sure he's not the only one who's basically checking out. Now, what happened in the stock market mainly, and I think this is the part where the Fed has fucked up a little bit, is the fact of the matter is that we could have handled this like people handle medical situation, right? If you have a medical situation, let's say you have a toothache and you need to go to the dentist and you have to get a filling, and you kind of put it to the side, you don't want to do it, you say, whatever, I don't want to go to the dentist, and you just wait for 6 months and completely ignore it, just say, whatever. In 6 months you wake up in the middle of the night at 3 a.m. and you can't breathe because of the pain. And that point, it's no longer a filling, it's already a root canal. And it's going to cost you 3 times more, it's going to be 4 times more painful, and your tooth is not going to look the same ever again. And your whole dental hygiene, health is in a worse position than it ever was if you just gotten a filling. So you paid more, it was more painful, and the result was not as good. So this is what happened with the Fed. The Fed pretty much had an opportunity to go get a filling, right? When this whole thing started, the Fed could have slowly started raising interest rates. But as you know, Jerome Powell and gang started saying that everything is transitory, and they held on to that for a long ass time. Now, because they did that, what ended up happening is, unfortunately, the markets don't listen to what Jerome Powell has to say. The economy doesn't operate based on Jerome Powell's schedule. So they let inflation go absolutely into this no man's land right now where we at. Now, at some point, even Powell and his friends realized, well, yeah, we got to address this. But this time, you got to go to the dentist and get a freaking root canal. So now they're front loading the interest rate hikes, 0.75, 0.75, 0.75, and you're going to have another 0.75, which is the quickest pace, at least since I'm in the market, and it's been a while. I'm kind of an old ass at 42 years old. So at least in my lifetime, not including when I was like a baby boy and shit, this is the fastest pace I've ever seen. And yet it's not making any dents. You just saw the job numbers, they're not that great. And it's a very precarious situation. Now, I heard Mohamed El-Erian talk about it, and he was using a different analogy. Not the dentist, he was saying basically when, you're just driving and you're supposed to brake because you're getting to an intersection, but you choose not to brake and you go like full speed and then just press on the brakes right before the intersection, slam on the brakes right before the intersection. I mean, first of all, you're not going to be able to stop on time, and everybody is going to fly out the windows, and it's going to be a horrible accident. So this is what's going on right now. The Fed is trying to slam on the brakes after letting this thing, run away, and it's going to be a very painful stoppage. It's going to be like a car accident, very painful, and I'm not sure they can do it cleanly. And this is why the market is behaving the way it's behaving. This is why it's so bloody, so negative, and so hard to make money in the market right now. And this is why my friend, who's a very cautious investor, is getting absolutely slaughtered. Now, the question is, should he leave the stock market or not? And that's a very good question. I'm going to answer this, and I'm not going to dodge this question like a lot of people do. Look, here's the thing. If you are a short-term investor, if you're a trader, this video is not for you. Because I don't know how to help you. I don't know. I don't play that game. Absolutely no idea. If I was a short-term kind of trader, swing trader, day trader, whatever, I'm looking in this market and saying, getting the fuck out of Dodge, right? Short term, it's not looking good at all. Inflation is at all-time high, geopolitics, we talked about it multiple times. There's so many negative catalysts coming down the pipeline. If I was a trader, I would be out this market, basically saying, I'm sitting this one out, boys. But if I'm an investor, it's a whole different strategy. I made a whole video explaining how a marathon isn't the same strategy like running a 100-meter dash. It's a completely different strategy. As a long-term investor, you're probably looking at about 20 years. Like this is your pension money for kids' school, whatever, right? It's a 20-year horizon. Now, in a 20-year horizon, even if you get a lost decade, which sometimes you can, I mean, even in 2000, we got like a lost decade and a half, right? Even with that in mind, the bull run that's going to come in later after this lost decade is going to be so powerful, you're still going to make 8 to 10% in the S&P 500 year over year. At least, I mean, I'm just not guaranteeing that, but I mean, historically speaking, that's what happened. So if you are a long-term investor and you're staying for 20 years, getting out when the market is on the way down is not always the best idea. And it's not because I think the market is going to V-shape itself back up like it did in 2020, because I think 2020 is never going to happen again. I know a lot of people talking about, well, this is going to be like 2020. No, 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 no. It has nothing to do with 2020. 2020 was fake. It was fueled by pumping money into the system by the Fed. This was completely artificial. The bounce back will never happen like that again. I don't think we ever see like a V-shaped crazy recovery. I mean, that was just manufactured bounce back by the Fed. I don't want you guys to be so terrified by what's going on right now that you miss when the market actually recover. Because I think there's a lot of pain ahead. I think the rest of this year, it probably will have a few bear market rallies, but on a general note, this year isn't going to be good. 2023 is probably not going to be good. But as a 20-year horizon, there's no point in getting out of the market. If you're staying in quality equities, if you're diversifying, if you're heavy into S&P 500 or similar ETFs, on a 20-year basis, it's very hard to imagine how you can find anything better to do with your money. Now, what happens a lot with people who jump out at time of crisis is they are too afraid to jump back in. And it's kind of a human nature. If you jump out right now, even if you time the, getting out time correctly, you might, because everybody sees what's about to happen. Let's say you time correctly the getting out part. You won't be able to jump back in, because every time you're not going to be sure, you're going to be terrified. There's no way for you to know if it's a bear market rally or a real rally. And let's say it was a real rally, and now everything is now 3 or 4 times more expensive than it was. And you're going to be like, well, I'm not going to pay 3 times more for the stock than it was just a month ago or 2 months ago. This is crazy. And then basically you miss the entire bull run that happens after this bear market. Timing that re-entry point is literally impossible. It's very, very difficult. It goes against every human nature. In fact, there's a very good study that was done, and I always keep referencing it because it's so good, by Market Sentiment on Substack. Go check it out. It's called Buy the Dip. In that article, they basically did a study about what happens to 3 investors. Those 3 investors invest in the S&P 500 $100 every month, and they start investing in 1998, 2 years before the dot-com bubble, and they do it all the way to 2022, the current present time, and they behave differently. One investor basically invests $100 every month, no matter what happens. One investor, the minute the index, the S&P 500, drops below a certain point, he stops investing until it bounces back up and regains that exit point that he had. So he only invests when the stock market starts trending upwards, and he stops investing when the stock market trends downwards. And one investor does the opposite. The minute the S&P 500 actually drops a little bit, drops below that point, the low point, he actually doubles down, and he keeps doubling down 200, 200, 200 every month until the S&P 500 goes back to that point. And at this point, he keeps investing back to normal, $100 per month. So one of them is kind of a double down. One of them is kind of, just keep investing no matter what, keep the blinders on. And one is cautious. He's basically saying, well, I'm only going to invest when the stock market is slowly going up. I'm not going to invest when it's actually coming down. The results were insane. After 3 years, after 5 years, after 10 years, 15 years, after present time, these 2 investors that kept investing either regularly or doubling down have annihilated the guy who was cautious. In fact, he was in negative returns for probably a good decade. I don't remember the numbers precisely, but I'm going to try and find it. A good decade or plus, he was in the negative, and they were already up 30, 40, 50%. The way it ended is all 3 guys actually made money. From 1998 to 2022, they all made money. The guy who was the most cautious did like 100%, 120%, so he just doubled his money over the course of 24 years. The other guys did closer to 300%, and now you get to see what I'm talking about. So they tripled their money over the course of 24 years. Not saying that it's guaranteed, because nothing is guaranteed. Even tomorrow is not guaranteed, as you know. You should know this. Nothing can be taken for granted. But staying in the market, time in the market, is always better than timing the market. Now, if you leave right now, imagine all the people who left in 2000, right? Or 2008. 2,000 people left. They're like, I don't want to have anything to do with this market. Boom. They missed the entire tech rally. True, it happened. It took like 10 or 15 years to develop, but it happened. It happened eventually, and they missed it because they basically said, I'm not in the market. Same thing in 2008. People got scared in 2008, got out of the market, boom. They missed a good decade and a half of a crazy bull run. So getting out completely and saying, I'm done with investing, statistically speaking, historically speaking, is not always the best idea. Now, if you want to hedge your risk, if you want to mitigate your risk, if you want to increase your cash position because you know that 2023 is going to be rough, there's a whole bunch of things you can do. In fact, I've made a whole video talking about 3 strategies to mitigate your risk going into a recession year like we're about to right now. I'm going to put the video right here for you guys. Go check out the video right now. The 3 strategies with its benefits and risks are detailed there. If you haven't yet, by the way, subscribe to the channel right here. See you tomorrow.